Hey, welcome! Seriously, welcome. Pull up a chair, grab some coffee, tea, whatever keeps you focused. You're about to learn something that could genuinely change your financial future. My name is Jack, and this is Module 1 of the Forex Trading Masterclass. Now, before we dive in, let me tell you what this is not. This is not one of those get rich overnight while sleeping on a beach in Bali videos. You know the ones I'm talking about. The ads with the rented Lamborghini and the guy yelling about his secret formula. Yeah, no. This is a real, honest, ground-up education. From someone who has lost money, learned the hard way, and figured out what actually works. Here's the truth. Forex is the largest financial market on Earth. Look at this number. $7.5 trillion every single day. Let me put that in perspective for you. That's more than the global stock market, more than the bond market, more than the entire crypto market, Bitcoin, Ethereum, all of it combined, then multiplied by, a lot. If you've ever wondered how banks, hedge funds, and professional traders move billions of dollars while you're sleeping, this is where you learn. By the end of this 30 minutes, which, let's be honest, might be 35 if I get excited and start rambling, you will understand exactly what Forex is, how to read currency pairs, what pips and spreads are, why leverage is both your best friend and your worst enemy, and most importantly, why most traders lose money and how to make sure you're not one of them. No prior knowledge needed. None. Zero. Zilch. If you can count to 10 and you know that up means higher numbers, you're qualified. Let's go.
Hey, welcome. This is Module 1 of my complete Forex Trading Masterclass, and I'm giving it to you for free. No catch, no email sign up, just real education. In this module, you'll learn the foundations, what Forex is, how pips and leverage work, why most traders lose money, and how to not be one of them. Now, this is Module 1 of 9. Here's the full course lineup. Module 1, Intro to Forex, you're here, free. Module 2, Trading Platforms. Module 3, Candlestick Psychology. Module 4, Trading Strategies and Risk Management. Module 5, Advanced Price Action. Module 6, Trading Psychology. Module 7, Scalping versus Day versus Swing. Module 8, Building Your Trading Plan. Module 9, Final Masterclass. The full 9-module course is just $30, one-time payment. That's less than 2 Domino's pizzas, or 1 month of Netflix and a coffee. One payment, forever access. Link in the description. All right, let's get into the lesson. Section 1. What even is Forex? Forex stands for foreign exchange. Fancy name, simple concept. It's the global marketplace where one currency gets traded for another. That's it. Every time you've ever exchanged money for a trip abroad, congratulations. You've done Forex. You just didn't know it. Now, currencies change value constantly. Why? Supply and demand. Same reason your favorite sneakers cost more when everyone wants them. Same reason avocados get expensive in January. Same reason concert tickets double in price the day before the show. Look at this chart on your screen. This is Euro USD. The euro against the US dollar. The two biggest economies in the world fighting it out in real time. When this number goes up, the euro is getting stronger. When it goes down, the dollar is winning. Simple as that. Now, here's what makes Forex different from stocks, crypto, or anything else you've seen. Forex is open 24 hours a day, 5 days a week. That's right. From Monday morning in Sydney to Friday afternoon in New York, the market never sleeps. There's no closing bell. No, sorry, market's closed, come back tomorrow. Now, you might be thinking, wait, who runs this thing? Is there a giant building somewhere with a bunch of people in suits yelling at screens? Nope. There's no central exchange, no Forex headquarters. Instead, trading happens electronically between banks in London, hedge funds in New York, corporations in Tokyo, and regular people like you and me sitting at home in our pajamas. Let me break down who the players are, because this matters. Player number 1, central banks. These are the big dogs. The Federal Reserve in the US, the European Central Bank, the Bank of Japan. They set interest rates. And when the Fed raises rates,
the US dollar usually gets stronger. It's like the principal of the school. When they talk, everyone listens. Player number 2, institutions and hedge funds. These guys move billions daily. They're converting currencies for international trade, investments, and hedging risk. They create the bulk of price movement. We're basically surfing the waves they create.
Player number 3, retail traders. That's us. That's you. Individual traders accessing the same market through online brokers. We only represent about 6% of volume. Small, right? But here's the secret. With the right strategy, we absolutely can profit from the moves the big guys create. We're like small fish swimming next to whales. The whales make waves, we ride them. Now let's make this real. Because Forex sounds abstract until you connect it to your actual life. Example 1, travel. You're going to Paris. You exchange $500 for euros. Congratulations, you just participated in the Forex market. Same market, same mechanics. You just paid the spread at the airport. Spoiler, airport spreads are terrible. Don't do that. Example 2, global business. Apple makes iPhones in China, sells them in Europe. They get paid in euros but need to pay suppliers in dollars. They have to convert. Billions of dollars of these transactions happen every single day. That constant conversion creates price movement. Example 3, speculation. That's what we do. We're not traveling, we're not running a business. We're simply betting on which currency will get stronger or weaker. Buy the one you think will rise, sell the one you think will fall. No physical currency needed, just a laptop and an internet connection. So that's Forex. Massive, global, 24/5, and completely accessible to you. Now let's learn how to actually read this thing.
Section 2, currency pairs. Here's the most important concept in all of Forex. And I mean all of Forex. If you forget everything else, remember this. You never trade a currency alone, ever. You always trade one currency against another. That's why it's called a pair. 2 currencies, side by side, fighting. Let me decode Euro/USD, because this is the most traded pair in the world. It's like the Beatles of Forex. Everyone trades it. On the left, the base currency. That's euro, the euro. On the right, the quote currency. That's USD, the US dollar. The price tells you how much of the quote currency it takes to buy 1 unit of the base currency. Right now, the price is around 1.0842. That means 1 euro buys approximately 1.08 US dollars. If the price goes up to 1.10, the euro is stronger. You need more dollars to buy 1 euro. That means the euro won, the dollar lost. If the price goes down to 1.05, the euro is weaker. You need fewer dollars to buy 1 euro. That means the dollar won, the euro lost. Simple, right? It's a tug of war. 2 currencies pulling in opposite directions. Now here's the key that will save you from confusion forever. When you buy Euro/USD, you believe the euro will get stronger relative to the dollar. You're betting on euro strength. When you sell Euro/USD, you believe the euro will get weaker relative to the dollar. You're betting on dollar strength. You are always picking a winner and a loser in every single trade. Now let me show you a real example.
Let's say Euro/USD moves from 1.1000 to 1.1050. That's a 50 pip move. We'll talk about pips in a minute, but for now, if you bought at 1.1000 and closed at 1.1050, you just made 50 pips of profit. If you sold at 1.1000 and the price went up to 1.1050, you just lost 50 pips. Ouch, wrong direction. Now, not all pairs are created equal. Think of them like different levels of difficulty in a video game. Major pairs, these always include the US dollar, Euro/USD, GBP/USD, USD/JPY, USD/CHF, AUD/USD. These are the easy mode. Tight spreads, high liquidity, lowest cost to trade. Start here.
Minor pairs? These don't include the US dollar. Euro GBP, Euro JPY, GBP JPY. Still good, still tradable, but spreads are a bit wider. Think of this as normal mode. Exotic pairs? USD TRY, USD ZAR, USD SGD. These are hard mode. Spreads can be 20, 30, even 50 pips. Volatility is crazy. 1 minute you're up, next minute you're down. Avoid these as a beginner. I'm serious, just don't. Here's a fun fact before we move on. The US dollar is involved in nearly 90% of all Forex transactions. 90%. That's insane. The dollar is basically the popular kid in high school that everyone wants to hang out with. Now that you understand pairs, how do you actually make money?
Section 3. Buying versus selling. Here's where Forex gets exciting, because honestly, this is my favorite part. In the stock market, and I love stocks, don't get me wrong, you can only profit when prices go up. The market crashes, you're stuck. You can only watch and cry. In Forex, completely different. You can profit whether the market goes up or down. Let me say that again because it's that important. You can make money in any direction. Up? Yes. Down? Also yes. Sideways? Okay, sideways is hard, but you get the point. Let me walk you through the two boxes on your screen. On the left, the buy trade, also called going long. This is for optimists. You believe Euro USD will rise, so you enter at 1.1000. The market goes up to 1.1050. That's a 50 pip move. You close the trade, you just made $50 profit. High five. On the right, the sell trade, also called going short. This is for realists, or pessimists, depending on your perspective. You believe Euro USD will fall, so you enter a short position at 1.1000. The market drops to 1.0950. Again, a 50 pip move. You close, also $50 profit. Same market, same day, two opposite directions. Both made money. Now, here's a joke for you. A stock trader and a Forex trader walk into a bar. The stock trader says, "I only make money when the market goes up." The Forex trader says, "That's cute. I make money when it goes up, when it goes down, and sometimes when it sneezes." Okay, that wasn't hilarious, but you get the point. Here's the serious insight that separates beginners from intermediates. When you buy Euro USD, you're betting on Euro strength and dollar weakness at the same time. Two currencies, one trade. When you sell Euro USD, you're betting on dollar strength and Euro weakness. You're not just guessing up or down. You're analyzing which economy is stronger, which central bank is raising rates, which country has better economic data. That's what professional traders do. They're not gamblers. They're analysts who happen to trade. Now, a quick warning before we move on, and I need you to listen carefully.
Just because you can trade both directions doesn't mean you should trade both directions. Many beginners jump back and forth, buying 1 minute, selling the next. That's a fast way to lose money. Pick a direction, have a reason, have a strategy, and stick to it. Okay, we know how to buy and sell, but how do we measure the moves?
Section 4, pips. This word sounds weird, right? Pip, pip. It's like a cute little bird noise. But in Forex, pips are everything. Pip stands for percentage in point. But honestly, you don't need to remember that. Just know this, a pip is the smallest standard price move in Forex. For most currency pairs, a pip is the 4th decimal place. Let me show you what I mean. Look at this number, 1.1000. Now watch what happens when I change that last digit from a 0 to a 1. 1.1001. That tiny little move, that's 1 pip. It's small, it's tiny, it's almost invisible. But when you're trading lots of money, those tiny pips add up fast. Let me give you an example that'll make this crystal clear. If Euro USD moves from 1.1000 to 1.1050, how many pips is that? 50. 50 pips, because the 4th decimal changed 50 times.
If it moves from 1.1000 to 1.2000, that's 1,000 pips. That's a massive move. That doesn't happen every day. But when it does, people get very excited or very sad. Now here's where the magic happens. Watch this interactive calculator on your screen. I'm going to move the first slider to 25 pips. Just a small move, nothing crazy. I'm going to set the lot size to 0.1. That's one mini lot. The calculator says 25 pips equals approximately $25. $25 from a tiny price movement. Not bad, right? Now watch what happens when I increase the lot size. I'm moving the second slider to 1. That's one full standard lot. Suddenly, 25 pips is worth $250. Let me do that again because it's important. Same 25 pips, same market move. But because I'm trading a larger size, the profit went from $25 to $250. That's the power of lot size. That's the power of pips. Here's a formula you need to memorize. Write it down if you have to. One standard lot on Euro USD equals approximately $10 per pip. $10 per pip. So a 10 pip move equals $100. A 50 pip move equals $500. A 100 pip move equals $1,000. Now, here's a joke to help you remember. A beginner trader asks a pro, how do you make a small fortune in Forex? The pro says, start with a large fortune. Laugh at your own joke, it's fine. But seriously, pips are small, but they add up. Respect the pip, love the pip, count the pip. Now, if every pip has value, what does it cost you to trade?
Section 5. The spread. Okay, real talk. Brokers are not charities. They're businesses. They need to make money. And in Forex, brokers make their money primarily through something called the spread. Here's how it works. Every currency pair has two prices. The bid price, this is where you sell. The ask price, this is where you buy. And the difference between them, the gap, is called the spread. Look at this example on your screen. The bid is 1.1000. The ask is 1.1002. The spread is 2 pips. That tiny 2 pip gap, that's the broker's cut. That's how they get paid. Now, let me explain what this means for your trade. If you buy at the ask price, 1.1002, and then immediately sell at the bid price, 1.1000, you would lose 2 pips instantly. You haven't done anything wrong. The market didn't move against you. You just paid the spread. Think of the spread like a cover charge at a club. You pay it just to get in, and then you can dance. Or think of it like this. Remember exchanging money at the airport? The booth says we buy at 1.10 and we sell at 1.12. That gap, that's the spread. Same concept, same math. Now, here's why the spread matters for your trading. First, tighter spreads mean lower costs. Euro USD during the London-New York overlap can have spreads as low as 0.1 pip. That's basically free. Amazing. Second, wider spreads mean higher costs. Exotic pairs can have spreads of 20, 30, even 50 pips. That means you start every trade already down 50 pips. That's like starting a race with weights tied to your ankles. Not impossible, just really hard. Third, spreads widen during news events. Big economic data comes out, jobs report, inflation numbers, interest rate decision, and suddenly the spread jumps from 1 pip to 10 pips. That's normal, don't panic. Here's a pro tip. Most beginner traders ignore the spread. They see a trade and jump in without looking. That's like buying something without checking the price tag. Check the spread before every trade. If the spread is more than 3 to 5 pips on a major pair, maybe wait, maybe trade later. Now, a quick joke to lighten the mood. Why did the Forex trader break up with the spread? Because the spread was taking too much and giving nothing back. Okay, moving on. The spread is your cost. Respect it, minimize it, and choose a broker with tight spreads on the pairs you actually trade. Now, let's talk about the most powerful and most dangerous tool in Forex. Section 6. Leverage. Before we say anything else, read this red warning box on your screen. I'll read it out loud for you. Leverage amplifies both profits and losses equally. A high percentage of retail traders lose money due to improper leverage use. Treat this section with maximum attention. That's not me being dramatic. That's a fact. Regulators make brokers show this warning because people get destroyed by leverage. Now, what is leverage? Leverage is a loan from your broker. That's it, a loan. It lets you control a position that is much larger than your actual account balance. Example, you have $1,000. Your broker offers 1 to 100 leverage. That means you can control a $100,000 position. Sounds amazing, right? You just turned $1,000 into $100,000 of buying power. Here's the catch. If the market moves 1% in your favor, you make $1,000. You doubled your money. Amazing. If the market moves 1% against you, you lose $1,000. Your entire account is gone. Zero. Wiped out. Game over. That's the reality of high leverage. Let me show you this live on the calculator. I'm going to set account balance to $500, just a nice round number. I'm going to set leverage to 1 to 10. The calculator shows I can control a $5,000 position. A 1% move equals $50, which is 10% of my account. Manageable. I can survive a few losses. Now, watch what happens when I increase leverage to 1 to 100. Same $500 account, now I'm controlling a $50,000 position. A 1% move equals $500, which is 100% of my account. One bad trade and I'm bankrupt. That's not trading, that's gambling with extra steps. Now, I'm going to give you a recommendation that will save you thousands of dollars. Seriously, I wish someone told me this when I started. As a beginner, use leverage between 1 to 5 and 1 to 20. That's it, nothing higher. I don't care if your broker offers 1 to 500. I don't care if your friend says he made $10,000 in one day with high leverage. Ignore them. Professional traders risk between 0.5% and 2% of their account per trade. Per trade. That means they can lose 20 trades in a row and still have 80% of their money left. High leverage traders risk 20%, 50%, even 100% per trade. They lose 3 trades in a row, they're done. Out of the game. Forever. Here's an analogy I love. Leverage is like a chainsaw.
Section 6. Leverage. Before we say anything else, read this red warning box on your screen. I'll read it out loud for you. Leverage amplifies both profits and losses equally. A high percentage of retail traders lose money due to improper leverage use. Treat this section with maximum attention. That's not me being dramatic. That's a fact. Regulators make brokers show this warning because people get destroyed by leverage. Now, what is leverage? Leverage is a loan from your broker. That's it, a loan. It lets you control a position that is much larger than your actual account balance.
Section 7. Market Sessions. Forex is open 24 hours. But here's the secret that most beginners don't know. Not all hours are created equal. Some hours are like a quiet library. Nothing moves. Spreads are wide. You're bored. Other hours are like a rock concert. Everything moves. Spreads tighten. Money gets made. Let me break down the 3 major sessions. First, the Asian session. Tokyo, Sydney, Singapore, Hong Kong. This is the quiet session. Lower volatility, less movement. The Japanese yen pairs are Let me show you this live on the calculator. I'm going to set account balance to $500, just a nice round number. I'm going to set leverage to 1 to 10. The calculator shows I can control a $5,000 position, a $15,000 position, a $150,000 position, a $150 check, which is 10% of my account. Manageable. I can survive a few losses. Now watch what happens when I increase leverage to 1 to 100. Same $500 account. Now I'm controlling a $50,000 position. A 1% move equals $500, which is 100% of my account. One bad trade and I'm bankrupt. That's not trading. That's gambling with extra steps. Now, I'm going to give you a recommendation that will save you thousands of dollars. Seriously, I wish someone told me this when I started. As a beginner, use leverage between 1 to 5 and 1 to 20. That's it. Nothing higher. I don't care if your broker offers 1 to 500. I don't care if your friend says he made $10,000 in one day with high leverage. Ignore them. Professional traders risk between 0.5 and 2% of their account per trade. Per trade.
That means they can lose 20 trades in a row and still have 80% of their money left. High leverage traders risk 20%, 50%, even 100% per trade. They lose 3 trades in a row, they're done. Out of the game. Forever. Here's an analogy I love. Leverage is like a chainsaw. A chainsaw is an amazing tool. It cuts down trees in seconds. But if you don't know how to use it, you cut off your leg. Same chainsaw, different result. Respect the chainsaw. Respect leverage. Now, a quick joke to release the tension. A trader walks into a doctor's office and says, "Doctor, it hurts when I use high leverage." The doctor says, "Then don't use high leverage." It's okay, it's a dad joke. So here's your homework from this section. Open your broker account. Look at the leverage setting. If it's above 1 to 20, lower it. Today. Right now. Future you will thank me. Now, let's talk about when to actually trade.
Section 7. Market Sessions. Forex is open 24 hours, but here's the secret that most beginners don't know. Not all hours are created equal. Some hours are like a quiet library. Nothing moves, spreads are wide, you're bored. Other hours are like a rager sessions. First, the Asian session. Tokyo, Sydney, Singapore, Hong Kong. This is the quiet session. Lower volatility, less movement. The Japanese yen pairs are most active. Good for range trading, good for patience. But if you like action, not your favorite. Second, the London session. This is the heavyweight champion. London opens and the market wakes up. Highest volume of any single session. All major pairs become active. Trends start here. If you could only trade one session, trade London. Third, the New York session. High volatility. The US dollar dominates. When US economic data comes out, jobs numbers, inflation reports, Federal Reserve announcements, the market can move hundreds of pips in minutes. Exciting, also terrifying if you're on the wrong side. Now here's the golden secret, the best time to trade. Look at the timeline on your screen. The London session runs from 8 a.m. to 5 p.m. UTC. The New York session runs from 1 p.m. to 10 p.m. UTC. They overlap from 1 p.m. to 5 p.m. UTC. That 4-hour window, just 4 hours, is the single most important trading time in all of Forex. Why? Because 70% of daily Forex volume happens during that overlap. 70%! That means maximum liquidity, tightest spreads, cleanest price movement, fastest trade execution. If you're a beginner trading Euro USD or GBP USD, this 4-hour window is your gold mine. You don't need to trade all day. You don't need to wake up at 3 a.m. You just need to be available from 1 p.m. to 5 p.m. UTC. Check your local time, convert it, block that time on your calendar. That's your trading window. Here's a joke for you. How many Forex traders does it take to change a light bulb? None. They're all waiting for the London-New York overlap to get better lighting. I'll stop now. But seriously, sessions matter. Trade with the volume, not against it. Now, with all this knowledge, why do most traders still lose? Section 8. Why most traders lose. This is the most important part of the entire module. I'm not exaggerating. Pay attention. Look at this number. 70 to 80% of retail Forex traders lose money. That's not because Forex is rigged. It's not because the market is impossible. It's because most beginners make the same 6 avoidable mistakes. Let me walk you through them. And be honest with yourself. Have you made any of these? Mistake number 1, over-trading. This is when you take too many trades out of boredom, excitement, or FOMO. You see a tiny move and jump in. You close a trade and immediately open another. It feels productive. It's not. More trades does not mean more profit. It usually means more losses, more spread costs, and more emotional exhaustion. Quality over quantity. Always. Mistake number 2, revenge trading. You lose a trade. You get angry. You say, "I'll get it back right now," and you immediately open another trade in the same direction. This is pure emotion. This is your ego talking, and it almost always makes things worse. Here's what you do instead. Lose a trade, close the laptop, walk away, get a glass of water, pet your dog, come back tomorrow.
The market will still be there, I promise. Mistake number 3, no stop loss. Trading without a stop loss is like driving a car without a seatbelt. You might be fine for a while, until you're not. The market can move 200 pips against you in minutes while you're in the bathroom, or sleeping, or eating lunch. A stop loss is your insurance. Use it every single time, no exceptions. Mistake number 4, gambling mindset. This is when you place random trades on gut feeling, with no strategy, no analysis, no plan. You're not trading, you're gambling. And the house, the broker, always wins eventually. Forex is not a casino. The odds are not in your favor if you're guessing. Treat it as a skill-based profession. Mistake number 5, emotional trading. Fear closes winners too early. Greed holds losers too long. You take a 10-pip profit because you're scared. Then the market goes 100 pips without you. That's fear. You hold a losing trade because it'll come back. Then it goes 200 pips against you. That's greed. Emotions are the number 1 enemy of consistency. Master your psychology before you master the market. And mistake number 6, over-risking per trade.
This is the big one. Risking 20%, 50%, or even 100% of your account on a single trade. Professional traders risk between 0.5% and 2% maximum. Let me say that again, between 0.5% and 2%. That means with a $10,000 account, they risk $50 to $200 per trade. Why? Because they want to survive. They want to be able to lose 10 trades in a row and still have 80% of their money left. Over-risking is the fastest way to blow your account. Don't do it. Now, here's the good news. Every single one of these mistakes is preventable. Look at the bottom of your screen. The successful trader's mindset, discipline, patience, risk management. The world's best traders lose trades regularly. They lose all the time, but they manage their losses brilliantly. That's the difference. Now, a final joke before we wrap up. Why don't Forex traders ever play hide and seek? Because good luck hiding when your stop loss is hunting you. Okay, that was terrible. Moving on. Let's recap everything you learned today.
You made it. 30 minutes. Probably 35. But you stuck with me. I appreciate that. Seriously. Let me summarize everything you learned today. Number 1, the Forex market. $7.5 trillion daily. Banks, institutions, and retail traders. Open 24 hours, 5 days a week. The largest financial market on Earth. Number 2, currency pairs. Base versus quote. Euro USD is king. Majors, minors, and exotics. The US dollar is in 90% of all trades. Number 3, buy and sell. Long means profit when price goes up. Short means profit when price goes down. 2 ways to win in any market condition. Number 4, pips. The smallest standard price move. 4th decimal for most pairs. 1 standard lot equals $10 per pip. Memorize that. Number 5, the spread. The difference between bid and ask. It's your cost per trade. Tight spreads on major pairs are your best friend. Number 6, leverage. A loan from your broker. Amplifies both profit and loss. Start with low leverage, 1 to 5 to 1 to 20. Respect the chainsaw. Number 7, sessions. Asia, London, New York. The London-New York overlap is the golden window. 70% of volume in 4 hours. Number 8, psychology. Discipline, patience, and risk management separate winners from losers. 70 to 80% lose because they ignore these rules. You now know more about Forex than most beginners who jump in and lose money. And here's the best part. This is just Module 1. In Module 2, we go deeper. Chart analysis, candlestick patterns, trend identification, support and resistance. The real technical skills that professional traders use every day. But before you move on, do me a favor. Review this module. Play with the calculators. Understand the spread. Respect leverage. Write down the 6 mistakes and put them on your wall. Trading is a skill. It takes time. It takes patience. It takes discipline.
But if you stick with it, if you follow the process, if you learn before you earn, you can absolutely do this. Thank you for watching Module 1. I'm genuinely excited for your journey. I'll see you in Module 2. Take care, trade safe, and don't blow up your account. Bye for now.
That's it for Module 1. Hope you learned something real. If you want the rest, Modules 2 through 9, hours of content, everything you need to build a real trading foundation, it's $30. One time. Link in the description. Thank you for watching. Seriously. I'll see you inside the full course. Let's go.